Some people want to make sure they have enough money to last forever. They want to pass money to the kids, to charity, to all these things. Then you have the folks who maybe they don't have kids, maybe they don't like their kids. Just kidding. Whatever the case is, maybe you don't want to leave a lot of money to anybody, and instead you want to spend what you worked hard for. Well, rightfully so. Well, for that, the planning is a bit different. Financial planning isn't something that you're going to look at a Monte Carlo and say, well, hopefully I have, $2 million at the end of the plan. It's going to be different, and I'm going to show you that and really how to factor in spending all of your money to the end of the plan. Now, with that, it doesn't come without risks. Now, any financial plan has risks, but truly it's just going to be a lot more of an elevated risk because you're factoring all these things, and if you live too long, inflation's higher, healthcare's higher, anything that happens, you're out of money. And then what do you do? Well, hopefully you'll have Social Security that will at least carry you the last couple of years, but you need to factor in for these kind of things, think through these things and scenarios. So let's start with the risks. As far as risks go, you've got a baseline plan here, and then you've got a market drop. That's a big one because market drops or just how the market performs in general is going to affect your plan. It's going to affect anybody's plan, but if you are wanting to spend all of your money down, it's going to affect your plan a lot more. Taxes, if taxes happen to be increased on you during the retirement years. Social Security, if it doesn't pay out as much. Longevity, that's a big one right there because if you're trying to spend all of your money down and you say, hey, I'm going to die at 90, great. Well, hopefully that works for you. But what if you live to 92? What if you have a large medical episode at 89 and you live till 92 and now that took a lot of the money? Another one is inflation. If inflation, well, we all know that one too well right now. And so if things just get outrageously expensive, in retirement, you're probably still going to have to buy a car. You're going to want homeowners insurance. You're going to want to have auto insurance if you're driving still, maybe not at 90, maybe so. My great-grandfather drove into his early 90s. He still drove until he had a stroke at 95. And so yeah, there you go. You could be still driving. Healthcare, if healthcare is more expensive. And then again, we talked about it a little bit, market drops, but also the asset returns. So those are all risks that you have to think through. Now, how are you going to actually figure out how to best spend down all of your dollars? Well, that's the one we want to look at here. And if we look at nest egg and general financial planning, what we talk through clients with is the Monte Carlo analysis, running 1,000 scenarios to factor in, what's really, the probability of success of you having this amount of money here, 71,000, or over here, 90%, 791,000. Generally speaking, what we're looking at with this, it's a bit more conservative than what I'm going to show you on the other side of things, which is the cash flow analysis. But when we're looking at this, we can stress test different things like I'd mentioned, whether it's up here at the stress test button, or I just say, hey, you're going to live till 92. I can adjust it in here just to say, okay, they went from 54% probability to 48%. So you're going to run out of money. What the Monte Carlo looks at, what general financial planning looks at is your confidence here. I mean, let's just say for simplistic sake, the world's best stock market, the world's worst stock market, and everything in between, it's finding a median line here. And so it's basically saying, hey, the median line is $71,000, and it's really just telling you that you got a 54% chance that you'll have $71,000 at the end of the plan. You're cutting it close there. But if that's your goal, that's your goal. Obviously, we don't want to focus on this one over here. The 90% probability of success is your current plan. You would potentially have $791,000 at the end of the plan. Yeah, that's a lot of money there that you're just going to be leaving on the table. And so how are we going to look at this for somebody who is wanting to spend it all down? Well, if we go over here to what's called the cash flow analysis, if you run an Excel spreadsheet, anything like that, you can do that just as easily on this of what we're looking at here. What it's doing is it's taking your returns and it's saying, okay, every single year you are going to get a certain return on your money, and every single year you're going to take a certain amount out. Kind of like you've heard of the 4% rule. So if you get 6% on your money and you withdraw 4%, it's going to last you at least 30 years. Same kind of concept on this, except for we're factoring in whatever the investment return is based on how you are currently invested. And your withdrawal rate isn't 4%. It's whatever you need for your goals and what you want to do. And so our goal here would be to say, hey, we're going to try to run out of money. What's interesting is looking at the Monte Carlo analysis. On Monte Carlo analysis, it's showing you have $71,000 remaining at the end of the plan. Well, if we scroll over here and we look, the cash flow says, guess what? You still have $529,000 at the end of the plan. The reason for that is the Monte Carlo is looking at, well, the market's going to go up. 1 year, you're going to get a 12% return. 1 year, you're going to get a negative 8%. The next year, you're going to get a 2% return. In all of those years, you are going to withdraw money. Versus the cash flow is a bit different of a perspective because it says, hey, you're going to get 6% every single year no matter what. We know the market doesn't work that way. And so for the person that's wanting to spend all of their money down, you're really going to have to stay on top of your plan. There's the opportunity that really what you could look at doing is saying, well, when the markets are really high, maybe I take a little bit more and a little bit more those years. When the markets are really low, and maybe those years I don't live on as much. So you could really just work the numbers, but this is something that you are going to have to really stay in tune with if your goal is to spend it all down. Because you've got to know that, if the market takes a large drop and you're in your 80s and you end up living till 95 and you've already spent down the money quite a bit, it's going to be tough out there. So just make sure that you're factoring in the different stress test scenarios like I mentioned here. When it comes to this, making sure that you're considering that, making sure that you have a financial plan that you are looking at. If you're looking at only a Monte Carlo analysis, consider looking at the cash flow as well to factor that in. And, if you're looking for a financial planner, somebody to help you with this, check us out, jazzwealth.com. We'd be happy to help you.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.